Most people struggle with investing because they focus on the wrong things. They chase quick profits, jump in and out of the market, and let emotions dictate their decisions. But the smartest investors follow key principles that help them grow wealth consistently over time, avoiding unnecessary risks and making data-driven decisions rather than emotional ones. Investing isn't just about choosing the right stocks or assets, it's about developing a strategy that stands the test of time. It's about understanding how to make your money work for you in the long run. The most successful investors don't rely on luck or market timing, they rely on discipline, patience, and proper risk management. History has shown us that markets go through cycles of growth and decline. While some investors panic and sell during downturns, others see these moments as opportunities. Understanding how to stay invested through uncertainty and volatility is what separates successful investors from those who consistently lose money. Today, I'll break down the essential strategies that separate successful investors from the rest. Whether you're just starting out or refining your approach, these principles can help you build a strong financial future and avoid the pitfalls that cause so many to fail. Let's dive in. Number 1. One of the biggest mistakes new investors make is thinking short-term. They get caught up in daily market fluctuations, reacting emotionally to price movements rather than sticking to a structured investment plan. This leads to panic selling, impulsive buying, and ultimately, losses that could have been avoided. Successful investors like Warren Buffett take a different approach. They focus on long-term investments and allow the power of compounding to work in their favor. By holding investments for years or even decades, they maximize returns while minimizing the effects of short-term market volatility. Take the S&P 500, for example. If you had invested $10,000 in an S&P 500 ETF 20 years ago, your investment would now be worth over $65,000, assuming dividends were reinvested. The key to this success? Patience and long-term thinking. Instead of chasing trends, successful investors buy assets with solid fundamentals and let time do the heavy lifting. This approach also eliminates the stress of daily price movements. Rather than checking your portfolio multiple times a day, long-term investors focus on the bigger picture, knowing that markets move in cycles and that downturns are part of the process. Another example is real estate investing. While property values fluctuate, those who hold onto real estate for decades often see tremendous appreciation. The longer you stay in the market, the greater your chances of benefiting from economic growth. Some of the wealthiest individuals in history, from John D. Rockefeller to modern-day billionaires, have built their fortunes through long-term real estate holdings. Another key component of long-term investing is reinvestment. Instead of withdrawing profits, investors who allow dividends and capital gains to be reinvested can benefit from exponential growth through compound interest. This simple principle has created immense wealth over time for those who understand its power. One additional consideration in long-term investing is inflation protection. While cash loses value over time due to inflation, assets like stocks, real estate, and commodities tend to appreciate. This is why experienced investors allocate a portion of their portfolios to inflation-resistant assets to preserve purchasing power. Number 2. Smart investors know that managing risk is just as important as making profits. Instead of betting everything on one asset, they spread their investments across different asset classes: stocks, bonds, ETFs, real estate, and even alternative assets like cryptocurrencies. A key concept here is risk-reward balance. High returns often come with high risk, but by properly diversifying your portfolio, you can reduce volatility while still achieving steady growth. This means balancing higher risk investments with more stable, income-generating assets. For instance, during a market downturn, stocks may drop significantly, but other assets like bonds or gold might hold their value or even increase. This kind of diversification acts as a safety net, ensuring that even if one asset underperforms, your entire portfolio remains stable. Another essential part of risk management is position sizing, allocating only a small percentage of your portfolio to high-risk investments. Smart investors never put all their money into one trade or asset. Instead, they use calculated strategies to distribute risk effectively. Additionally, Setting stop-loss levels can prevent catastrophic losses. A stop-loss order allows you to set a predefined price at which you will exit a losing position, helping to avoid emotional decision-making in the heat of the moment. One additional concept in risk management is hedging. Sophisticated investors use options, inverse ETFs, or alternative asset classes to protect their portfolios during market downturns. Hedging doesn't eliminate risk, but it helps mitigate potential losses. Even the biggest hedge funds in the world employ these techniques. Ray Dalio, the founder of Bridgewater Associates, has built his investment empire on a strategy called risk parity, which ensures his portfolio is balanced across different asset types to withstand market fluctuations. Understanding and implementing even basic versions of these risk management strategies can significantly impact an investor's success. Another advanced risk management technique is the use of safe haven assets. During times of uncertainty, institutional investors often move capital into assets such as gold, government bonds, and defensive stocks. Understanding these market dynamics can help protect and optimize your portfolio during different economic conditions. Number 3. The best investors aren't just good at picking assets, they master their emotions. Financial markets are unpredictable, and fear and greed are two emotions that can destroy even the most well-thought-out investment strategy. The stock market is designed to test your patience. Many people panic sell when prices drop, thinking they're minimizing losses, only to see prices recover soon after. Others buy impulsively during a market rally, afraid of missing out on potential profits. This is known as FOMO, fear of missing out. But successful investors remain disciplined, sticking to their strategy regardless of short-term price movements. A great example is the 2008 financial crisis. While many investors panicked and sold their stocks at huge losses, those who stayed invested and even bought more during the downturn saw their portfolios recover significantly over the next decade. Investors who focused on long-term fundamentals rather than short-term fears ended up making substantial gains. Having a clear investment plan and sticking to it is key. Ignore the daily noise of financial media, avoid emotional reactions to market swings, and focus on the data. The market rewards patience and consistency far more than impulsivity and speculation. One psychological trick that long-term investors use is automation. Setting up automatic investments through dollar-cost averaging removes emotional decision-making from the equation. This ensures that you are consistently investing, whether the market is up or down, taking advantage of long-term growth trends. Another powerful technique is journaling your investment decisions. By writing down why you are making an investment, what your expectations are, and what your exit strategy is, you can hold yourself accountable and avoid emotional trading mistakes. So let's recap the key principles that separate smart investors from the rest. Checkmark: focus on long-term investing and let compounding do the work for you. Checkmark: manage risk effectively through diversification, position sizing, and hedging strategies. Checkmark: develop the right mindset and patience to navigate market cycles without emotional decisions. Smart investing isn't about making quick money or chasing trends, it's about following proven strategies that stand the test of time. If you found this useful, make sure to subscribe for more insights on how to build wealth the right way. Thanks for watching, and see you in the next